Hey everyone, welcome back to Corporate Decoder, the place where we decode the confusing world of finance and business. Sometimes it feels like they are writing in a secret language, doesn't it? In this video, we're diving deep into Twist Bioscience Corporation's latest 10K filing. We're talking about their most recent yearly performance, what's driving their business, and more importantly, where their risks and opportunities lie. Oh, and we will see if they are making any money finally. Before we start, if you appreciate getting straight insights from corporate documents without all the fluff, hit that subscribe button. And if you want to dive deeper and chat with us about these filings, join our Discord community. The link is in the description below. Twist Bioscience Corporation is giving us the full picture of their year, and a lot has been happening. Let's get straight to the financial tables because numbers tell the real story. First up, revenue for the year ended the 30th of September 2025, hit $376.6 million. That is a solid 20% jump from last year's $313 million. This growth is mostly coming from their NGS tools, which is their biggest segment, and synthetic genes. More customers, especially in healthcare and industrial chemicals, are buying their products. Now, the cost to make those products, the cost of revenues, went up by about 3% to $185.6 million. But here is the key insight: while revenues jumped 20%, the direct costs only went up 3%. This is a fantastic sign, suggesting they are becoming much more efficient at producing their goods. This efficiency is reflected in their gross profit. It shot up by a massive 43%, reaching $191 million. And look at that gross margin, it climbed from 42.6% last year all the way to 50.7% this year. That means for every dollar of revenue, they are keeping over 50 cents after covering the direct costs of making the product. This significant increase in gross margin is a big positive sign, showing better operational leverage. Moving on to research and development, these expenses actually went down by about 12% to $80.3 million. This decrease is partly due to their decision to sell off their DNA digital data storage business, which means less spending in that area. However, the company is still investing in R&D, which is crucial for a tech-focused company like this. Selling general and administrative expenses, or SG&A, did go up by 13% to $247 million. This is mainly due to higher stock-based compensation for employees and increased it and marketing costs. While this is a significant number, it's not growing as fast as their revenue, which is good. Even with the revenue growth and improved gross margins, the company is still not profitable. Their loss from operations for the year was $136.3 million. This is better than last year's hefty $220.8 million loss, so they are heading in the right direction, but still a long way from profitability. A big bright spot this year is the $48.8 million gain on the sale of their DNA digital data storage business. This sale allowed them to focus on their core synthetic biology and NGS tools, and it brought in some much needed cash. Overall, their net loss attributable to common stockholders was $77.7 million. Again, this is a significant improvement from last year's net loss of over $208 million. So, while they are still losing money, the bleeding has slowed considerably. Let's look at cash flow. Net cash used in operating activities actually decreased to $47.6 million from $64.1 million last year. This is a good sign, as it means they are using less cash to run the core business. As of the 30th of September 2025, they had $183 million in cash and cash equivalents. This is down from about $226 million last year, partly because of the business sale and investments, but it still gives them a cushion to operate. Now, I want to highlight something interesting in the balance sheet. Look at the investment in equity securities. It jumped from $1.5 million last year to over $53.9 million this year. This is directly related to that DNA data storage business sale where they kept an equity stake in the new company, Atlas Data Storage Incorporated. This shows a strategic move to retain some upside potential from that divested business. Of course, with any company, especially one in a cutting-edge field like synthetic biology, there are always risks. Twist Bioscience is very open about them. One of the biggest, as they've stated, is that they have incurred net losses in every period to date and may never achieve profitability. This is a recurring theme with growth companies, but it remains a significant risk for investors. Another major concern is their heavy reliance on a single source supplier for a critical component in their DNA synthesis process. That sounds like a potential bottleneck waiting to happen, and in some recent news, they've signed an amendment to a lease for their South San Francisco facility. This isn't just a small expansion, they are taking on a lot more space, about 33,000 square feet, and extending their lease until 2036. They're also getting a significant tenant improvement allowance of $24.4 million. This signals a strong commitment to their physical infrastructure and likely points to expected future growth requiring more lab and office space. They're preparing for what they believe is coming. And finally, the auditors, Ernst & Young LLP, have given their stamp of approval on the financial statements. They also confirmed that the company maintained effective internal controls over financial reporting. This is always good to see, so my take on Twist Bioscience Corporation. They are making significant strides in improving their efficiency and reducing their losses, which is highly commendable. Revenue is growing and their gross margins are looking very healthy, showing they are getting better at making money on what they sell. The sale of the DNA data storage business and the subsequent investment in Atlas appears to be a smart move, allowing them to focus resources and still potentially benefit from that area. However, the core risk of not yet being profitable and their heavy dependence on that single supplier are risks that cannot be ignored. They are in a rapidly evolving and competitive industry, and staying ahead requires constant innovation and careful risk management. Overall, this filing shows a company that is maturing, improving its operations, and making strategic moves to manage its resources effectively. They are definitely on a path of improvement, but the ultimate goal of profitability is still on the horizon. Alright, that is our breakdown of Twist Bioscience Corporation's latest filing. What is your take on these numbers and what they signal for the company's future? Are you excited about their growth, or are the risks too concerning? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more deep dives into corporate filings. Don't forget to check out our Discord community in the description for more discussions. Thanks for watching and see you next time on Corporate Decoder.